Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Today's podcast is sponsored by Founders Card. I usually don't spring for paid membership programs, but this one is a little different. The offering is targeted to entrepreneurs and business owners, and the card enables premier benefits from leading airlines, hotels, lifestyle brands, and business services. A few of my favorite benefits include free access to MailChimp Pro, Dashlane Premium, and TripIt Pro. You can even get big discounts to services I love like Silvercar, 99 Designs, Apple, and AT&T. My favorite, though, are the travel benefits, where you get an automatic status such as Hilton Honors Gold, American Airlines Platinum, and Virgin America Gold. And while I often use the great app Hotel Tonight for travel, the Founders Card discounts can be massive too. If you go to founderscard.com/MEB, podcast listeners can sign up for the discounted $395 a year with no initiation fee, and that's a saving from the normal cost of around $600 per year. Again, that's founderscard.com/MEB. Welcome to a summertime podcast. Sitting here with co-host and podcast show producer Jeff. Welcome, Jeff.
Hey, what's happening?
Not much. Winding down, getting ready to have my birthday here in about a week.
Congrats.
Thank you. Very little. Thank you very little.
What are we doing for it?
Is that Chevy Chase line? What is that from?
Fletch.
Let's see if we can pull up the video for that. I don't know what I'm going to do for it. Hide in a dark closet. Avoid. No, I love birthdays. Listeners, if you want to send me a birthday present, feel free.
Are you willing to reveal what you're turning?
We've gotten quite a few weird presents so far from listeners.
Deflection.
We've gotten smoked salmon, ice wine. Jeff got a bottle of tequila, which he promptly took home. No, didn't share with anyone.
We haven't received enough.
Margarita Friday we need. So we're wedging this. We're doing a Q&A radio show in between. We had a fun one with Axel Merck, and then we have a really exciting one coming up with Dr. William Bernstein, who, if you have questions, please send him in. He's one of the oft-requested podcast show guests, and it's going to be a lot of fun. So if you have any, we're looking forward to it. It'll be out next week.
Cool. Well, why don't we dive in with some tweets that you made over the last week, and then some reader Q&A.
You saying that, it makes my stomach turn a little bit, saying like, let's dive into some of your tweets, because I feel like sometimes it's hard for me not to behave poorly on Twitter, but go ahead, fire away.
All right. First one is, it's a tweet that actually it referenced Cliff Asness, where he was rebuffing a Bloomberg article called The Death of Value Investing. So the article claims that value isn't working, says sticking to that approach has resulted in a cumulative loss 15% over the past decade, according to Goldman Sachs. During roughly the same period, the S&P 500 was nearly double. So first, why has it underperformed so much?
I imagine that stat is not straight up value has lost. It's probably long short or value versus growth, depending on where you pulled that quote. So it's definitely underperformed the market cap, but almost everything is underperformed market cap weighted in this cycle, which is normal and it's fine. I mean, it's so much of what goes on in investing is the ebb and flow, the waxing and waning of styles and countries and sectors and strategies. And that's just kind of the way that it is. You know, things go in and out of fashion. You have times when market cap is crushing everything else and the U.S. is crushing other countries. You have times when Greece is outperforming, like this year. So it's a lot of these things are, you know, you see it on managed futures every 5 years. Managed futures is dead. Trendfollowing is dead. And then fast forward another 5, years after everyone's rushed in and it's been an unbelievable performer. You know, it's same story.
Well, one of the things the article is trying to claim, it's got a chart which we'll post, and it draws a smooth line over the course of, I guess it's since 1930. And the line basically follows a consistent progression. And apparently we've truly broken this since looks like around 2010 or so. So, I mean, do you see this as potential, based upon what you just said, is this where mean reversion is going to mean that we're way undervalued right now in terms of value as a factor and it's come roaring back? Or do you think something can potentially actually change from a structural perspective and it is, broken?
Well, who knows? I mean, look, you have like the late 90s, for example, and that's a classic example of, things continuing longer than people expect. And in many cases, and I don't think we're in a bubble, but when bubbles get into late stages is when a lot of people can make a lot of money. And so it could continue on for a couple of years, but that's the way that it works. I mean, our friend Wes talked about it as the value pain train, and we often cite the example of Warren Buffett's 13F holdings underperforming 8 of the last 10 years. But these things happen, and that's just kind of the way that it goes. And it's not just value; it's tactical. It's everything you hear in the news today about active versus passive, and all the flows going into passive and passive crush. These things have a way of coming in and out of favor. I mean, in general, you still want to make smart bets and investment approaches that are kind of tried and true, as opposed to just flipping around to whatever happens to be working today.
We talked about flows. Is this just an example of, the source of value being underperformed? Or let me back up. If it actually was doing well, I would assume that's because flows were chasing performance. It was doing well. Is this then what we're seeing, basically investors chasing the hottest factor, and then sort of behaviorally, they bail at the wrong time, they buy in at the wrong time, and basically it's going to come back now because everybody's out of it? That's, you kind of described the whole mean reversion concept, right? Is that, but you never know. You don't know if that's 1 month, if it's 5-10 years. And so there's what you want to take remember, you got to take a long-term view and always ask yourself, has something changed? And is there a reason to why we should be thinking about it differently? We talk a lot about dividend yields and dividend stocks and shareholder yield, and that's a case where things have changed. But in general, value as a concept, no, of course not. Now, every bull and bear market has different personalities, and it's same old stuff. Okay. Well, keeping on the topic of factors then, you just tweeted about a New York Times article in which Burt Malkiel reversed his stance on passive versus active investing, now generally believing that active investing can exploit certain market inefficiencies. Now, it's kind of ironic that this comes when he's backing Wealthfront's new advanced indexing service, which is a form of smart beta. So it's not really my main question, but first, I'm curious whether you see this purely as a marketing move or...
Look, I think Burt Malkiel is a national treasure. I mean, I think he's one of the legends of investing. His books, I think, are excellent. I think you always need to separate people from kind of what they're saying and what they do. Burton's been on the board and chairman and investment advisors of it's like 20 or some companies. I mean, I remember one's like an active emerging market fund that charges 2% a year, right? So it's kind of, what you say and what you promote, necessarily like what you do. So I've always just kind of smiled when I hear Burton in the press talking about these things. And Wealthfront being one where he's been kind of the CIO of it, and they've kind of been famous critics of smart beta. But, look, I applaud them from saying, hey, we think there's potentially a better way than market cap weighted indexing, and so I think it's a smart move what they're doing, and I don't have any problem with it. But it's kind of funny when you see people. Silicon Valley loves to pivot, and it's a good thing in general. You're doing something wrong, you pivot, great. You change. We I think that's a wonderful thing. Say, look, when you're doing something wrong, you improve. That's the foundation for becoming a better person, becoming a better investor, right? As you change. But it's kind of funny that it depending on how you project yourself prior. So if you're philosophically, very opposed to something and then change your mind, like Silicon Valley calls it a pivot, probably the rest of the country calls it just being full of shit, depending on how you go about it. So if you're like, picking fights with people and saying how this is a terrible way to invest, and then you kind of pivot to it, like, is it because you're trying to find a better market fit and something to distinguish yourself from the competition, or do you really believe it? And so a lot of these cases, look, I think it's a good improvement. I think it's a smart thing to do. I think the evidence says, you should probably move away from market cap weighting. Like, I have no problem with that, but it's kind of like we're from the South, Southern preacher being like, you should never drink. You people are going to hell. You should, you're not. Then says, oh, you know what? A glass or two of wine every weekend's fine. And it just kind of has a weird feeling to it. So I just kind of laugh. It's a humorous article, but I actually think it's a step in the right direction. I think they're making a smart move. I mean, they are still using high dividend yield as a factor, which we've talked about in the past. An article we did, which is you should basically never own high dividend yielding stocks in a taxable account. We can talk about that later, but there's still quibbles I have. But the whole thing about these robos, the top four, by the way, they just announced that Vanguard is now up to $65 billion in assets. So that's bigger than the next three combined. And they're a bit of a cyborg, so they come with a financial advisor. But Schwab is second at like 20-some billion, and then Betterment and Wealthfront. They're all good choices. I think they're totally reasonable choices. Now, my philosophical leanings, and obviously I'm biased because we run a digital advisor, is that something like the way we do it, or Wes at Alpha Architect, the way they do it, which is a little more tactical with some trend following inputs, I think is a better solution. But I think all four of those are just fine. I think they're all good solutions.
Makes me think of your idea that somebody tracks the various robos.
Yeah, there's a good website. Somebody listening should do it. You should come up with 10 default portfolios for each of the robos, because none of them report performance for some unknown reason. Set up a robo tracker website, and every journalist on the planet will subscribe to your website. I don't think it'll make any money, but...
So the curious thing to me about that article with Malkiel was actually a couple quotes from Rob Arnott. One, he said that pretty much everyone is looking at the same factors, which is a danger. He added, it's a very crowded space. If 10,000 quants are all looking at the same data and trading on it, the chances are it's not going to work. So, it kind of makes me wonder, investing now is different than, call it, 30 years ago, because it seems like there is a lot more market scrutiny of all sorts of factors and whatnot. And the one that sort of persists, the time, is really the behavioral element. How do you not react? What do you think is the best way to capture the behavioral side? Is it trend following?
Well, so Rob he's been talking a lot. They've been doing a lot of research at Research Affiliates about factor timing, and so that's been a very big topic discussion over the past year or two, with a lot of people falling on different sides of it. Can you time factors, and meaning, say, a factor like, for example, price to book or dividend yield? That historically, let's say it adds 1% to 2% performance over market cap weighting, but there's times when, because of money rushing in, and dividend yield's a good example. So 1999 dividend yield, high dividend yielding stocks traded at 50% valuation discount the overall market, and on average is 20% over time. Now it's a premium over the past few years for the first time ever. So a common sense person would say, well, okay, it makes a lot more sense to allocate to high dividend yielders in 99 when they're a huge valuation discount, and it makes no sense now. And so theoretically, I really want to believe that factor timing is possible from a common sense standpoint. And Research Affiliates has shown research that shows if you sort factors based on, I think it's their last 3 or 5 or something year performance, and valuations, that there's additive performance by tilting away from the high valuation and the ones that have done the best. So they have a beautiful new website, by the way. If you go to Research Affiliates, asset allocation module that lets you look at a lot of these factors and compare the current basket to history, and is that current basket expensive or cheap? Right. So you have a factor like momentum. You say, oh, wow, it's falling in the top decile of most expensive or under, really cheap right now. And so maybe it makes more sense to be owning that. And so
is that valuation component, is that relative to itself, or is there more of an absolute?
It's that's a good question. I'm trying to remember. I think I'm blanking. I can't remember if it's relative to its own history or relative to the current market. I don't know. Go check it out.
Okay. Well, but tying back to that was an answer.
I forgot the question. What was
that
the
was
question?
An answer based on factors. What I was wondering is, what do you think of when you're trying to exploit the behavioral biases we have? Is it trend following to sort of go with what the direction is, what the behavior, what the sentiment is, regardless of factors such as, you name it and just sort of go with the bias?
There's a couple different approaches as far as implementation. So first is, look, I'm going to put together a portfolio of these factors, and that's that. They'll balance out over time. So I'm going to own some value, I'm going to own some momentum, rebalance once a year, whatever. Okay, that's one. Two is that trend following certainly works, and it's a different approach. Right, and
you don't consider that a factor, do you?
Right, but so no, trend following, no,
just like an overlay.
It's an active management overlay on anything. So you could overlay trend following on corn prices, or gold, or the Swiss franc, or Bitcoin. Right, you could overlay trend following on dividend stocks. So you're applying a active management approach to a factor based approach, and I think it works great over time. And philosophically speaking, lines up, but if you're looking at a lot of these factors, we're talking a little more about mean reversion, where if a factor has done really well over the past XYZ years, that maybe it's time to be moving away. So rebalancing is certainly one solution, as is potentially what Rob had talked about in our podcast. This is over rebalancing, meaning here's a good example. So if you're doing factors with global valuation of countries or something, where you say, all right, well, this cheap basket of countries is in the cheapest it's ever been. Maybe it makes sense, instead of just rebalancing a little more. So if that's 10% of my portfolio, instead of rebalancing back from 8 to 10, we actually rebalance up to 12 or 15 or something. So it's just kind of turning the dial a little bit more. But again, all this stuff plays out, and it's simple to look at, because I'd been thinking for a long time, what is going to be the bubble or the tell of this market cycle? So late 90s, internet stocks and a lot of other tech, right? Super expensive. Not the case now. Tech stocks, totally reasonable compared to their history and the market. 2007 was a lot of leverage and credit, as well as real estate. This market cycle, I'd often scratch my head. You see little mini bubbles like Toronto real estate, where Pitbull and Tony Robbins are speaking at conference pumping Toronto real estate, right? But you're starting to see a lot of bubble-like behavior with cryptocurrencies. A lot of people have no business ever getting involved. And the stories, the story of this man put in $1,000 and now he's a millionaire.
I think I saw Ethereum is up 4,000% this year.
And then there was some flash crash where it went down to 13 yesterday. It's drawing in people. Now, this does not mean, again, if you would compare it to something like NASDAQ late 90s, is this 96 with cryptocurrencies, or is this 99?
Well, but to what extent? I mean, this is a small pocket. You're talking about cryptocurrencies, and you were asking a moment ago, what's going to sort of burst this market? Cryptocurrencies don't have that much control over the broader market.
No. They're an afterthought. But I'm just saying, you start to see bubble-like behavior in areas, and usually it involves leverage or credit or just people being somewhat foolish. And a lot of the cryptocurrency stuff goes on outside the U.S., by the way. It's not necessarily on a day-to-day basis. I mean, we go to lunch or dinner tonight, I can't pay with Bitcoin. San Fran, you probably could. But that's about it. Anyway, but the whole point is that if you look at the history of investing, is all of this stuff just ebbs and flows, and you see the same stuff over and over again. And the media is particularly wonderful about usually getting it wrong on time frames, where when they're calling for the death of a particular style, it's usually an interesting time to be interested. Yeah. And vice versa.
Okay. Well, another quote from Arnott in that same article, he says, smart beta can be smart, and then it can be not so smart. There are tons of strategies being offered now based on nothing but back tests. Anyone can create a brilliant strategy with the benefit of hindsight. But does that mean anything for future returns? I'm curious, bring this up because, a lot of what we do in-house is we look at things from a backtest perspective. So I'm curious as to your thoughts on how to distinguish between accurate, effective backtests with integrity versus those that are manicured or contrived or whatnot.
I think the biggest benefit of backtesting is simply, it's like reading about history. So understanding what markets have done in the past. And if you just relied on backtest and didn't use any sort of common sense, one thing would be, all right, well, you should never invest in China or Russia or Argentina or Egypt or Japan, because at one point they've essentially lost the entire equity market. So you should never invest in that. That would be a weird sort of takeaway, right? But in general, it's just like have a respect for history and understand what's possible and what, can happen. Most young investors, if you were to tell them, the United States government actually confiscated people's gold, made people turn it in 100 years ago almost. Can you imagine the U.S. government doing that? I say, well, you're kidding me, right? That's crazy. Or if you said, the U.S. market has dropped by over 80% before, and commodities and REITs in the last bear market dropped by over 70%. All these sort of takeaways, it's like it actually probably makes you a lot more backtest in general in a healthy respect for history, gives you probably a lot more conservatism and a lot more respect for what can and does happen. So, but if you flip that and say the people that are backtesting equity strategies to 2000 that are saying, hey, look, this trade on Thursday, buy on Monday strategy, has worked and beaten the S&P by 10 percentage points a year since 2000, like that doesn't really check the box to me. So to me, it's just learn as much history as possible, understand as much as possible what has happened and why, and then just put on a little common sense.
Okay, yeah, I hear you on that, but I think
here's a good example. So let's say you're a trend follower and you say, you know what? I love the 200-day moving average. It's a great strategy. And you look at it just back to 1999. Well, trend following has worked incredible since 99 because it missed two huge bear markets for the most part, right? But then you take it back to the 80s and you understand, oh, okay, well, actually, depending on the trend following metric you used, it would have either sat in or out the 1987 crash. And that's a pretty big binary event. You either woke up that day or that month and were up or down 20%, depending. But had you not backtested, you wouldn't really have that sort of understanding. And so there's so much that, going back to the original comment about, Cliff Asness at AQR says, you take a lot of these backtests and going forward, he's like, I like to take the drawdown and double it. And we have the concept that your largest, and it's factual, the largest drawdown is always in the future. And this is why a lot of people are surprised about 2008. A lot of the endowment style models, a lot of people had a buy and hold model that was globally diversified. And the largest drawdown going into that was probably 20%-ish. And it doubled. An endowment style portfolio probably had a drawdown of 50%. Harvard endowment, if it was mark to market on a monthly basis, would have lost half. You having a healthy respect for history, but also understand that, things can go wrong and do, and that there's worst cases, and understanding why your back test may be overstated or may not work as well in the future. I mean, look at price to book as an example, as a factor. The most famous probably value factor that's been around for decades, and then has had countless funds and strategies that have been based on price to book. DFA, original pioneer, and they're at $400 billion, but because so much money has moved into it, it's been one of the worst factors since then. So we like to apply a little common sense and generally kind of understand. I mean, we had a guy email us the other day and said, hey, Meb, I was curious, looking at this strategy that they just launched 5 months ago, I'm wondering why it's underperforming. And I said, are you serious? Like, this could go years underperforming. But, unless there's a big education gap, I think, too, which is tough.
But to what extent, though, I guess, what's the biggest mistake when backtesting? I think of like survivorship bias, but are there some other sort of obvious, egregious mistakes that you can avoid?
Well, there's a lot of like really bad one-on-one mistakes that I actually don't like even count. So I don't even count survivor bias because that's so egregious that, and survivor bias listeners, that's like, for example, if you were looking at historical stock performance, but excluding stocks that no longer exist, that would give you a very inaccurate historical backtest. And it's actually surprising how many of these research websites that I've used in the past do things like don't include dividends or don't include delisted companies. And so people used to send me backtests or talk about that, say, look, this, no offense, but this is worthless. You're excluding, it's not even remotely close to reality. And or saying, look at mutual funds that only exist today.
So if we have listeners who are looking for more of a pure data set, where would they find it?
It depends on what they want to do. If they're just looking at asset classes, that's pretty easy. We have some tabs on our website if you search historically like free data sources. So French Fama has stock data on a monthly level for asset classes and countries and styles going back to like the 20s. But if you're looking at individual stock basis and wanting to do back tests, I mean, there's a number of websites that'll let you sort and back test. I mean, if you had access to a business school fact set, which will otherwise cost you like 50 or 100 grand or something. But there's a lot of websites, and we mentioned them on our blog many times in the past. If you search like tactical back testers or something, there's a lot of ones that'll do it. There's never been a greater time in history that has more access to the data than now. So that's like a 101. Like, I don't even count that as a mistake, because that's just like a do not even get to go starting point sort of mistake. But a typical mistake would be something like, you're looking at 100 factors and then optimizing the best 10 over the last 10 years and expecting that to continue. That's a short time frame, considering that there's styles that go in and out of favor for an entire decade or more. And again, like going back to that old comment about everyone having the same data set, I agree with that. Everyone, I was making this comment in the mid 2000s, interviewing in a quant hedge fund. You go type up on Yahoo Finance, which, rest in peace, by the way, I don't even know that they're supporting it anymore. Type in a ticker symbol and see who owns it. And it's 5 of the most famous quant funds. It'd be like D. Shaw, LSV, AQR. So they kind of all arrived at the same conclusion. But there's certainly, if you're a quant, and there's a great podcast that Patrick O'Shaughnessy did with the CEO and founder of Estimize a few weeks ago that talks about this. And it says, a lot of these quant shops, the new value adds become finding new factors, new data sets, and finding ways that people, either you have data that no one else has, or you look at the data differently. But the flip side of that, if you're an individual investor, like, my God, how am I going to compete with that? There's another quote from Josh Brown. He's like, the alpha is to do the opposite and to be as dumb as possible and to take a step back and operate at a totally different time frame where, you're not necessarily doing high frequency trading or, trading the ultimate quant stock factor model in the US. Maybe you're applying it to Malaysian securities or frontier markets or private equity companies. There's a lot of different ways to skin a cat.
I remember reading some quote that basically arrived at the conclusion that the greatest alpha that retail has is just time frame, just long term. We are not competing like asset managers, short term needing performance to keep your job. So if you're willing just to be patient and stick with your strategy and have a longer term perspective.
I love the coffee can strategy portfolios, which is people that have bought stocks and then just put them away. And I actually think that's a great way to buy a portfolio. We talked about this in a prior episode where I said you could buy an investment and never sell it. Yeah. So it has to stay there no matter what. So these people that end up owning, GE for 40 years or Reynolds Tobacco or whatever it may have been, that have these just, you read the story about the janitor that just left $4,000 or $4 million to local Audubon Society because he owned stocks that he just never sold.
Yeah, there's a million stories like that.
Yeah, and it's great. And I think that's a totally reasonable way to invest. And now a word from our sponsor. Today's podcast is sponsored by FreshBooks, the best cloud-based small business accounting software. Look, I've never taken an accounting class in my life and found FreshBooks easy to navigate within the first 30 seconds. Here's an example. Say you're racing against the clock to wrap up 3 projects, prepping for a meeting late in the afternoon, all while trying to tackle a mountain of paperwork. Welcome to life as a freelancer. Challenging? Yep, but our friends at FreshBooks believe the rewards are so worth it. Look, the working world has changed. With the growth of the internet, there's never been more opportunities for the self-employed. To meet this need, FreshBooks is excited to announce the launch of an all-new version of their cloud accounting software. It's been redesigned from the ground up, custom built for exactly the way you work. Get ready for the simplest way to be more productive, organized, and most importantly, get paid quickly. The all-new FreshBooks is not only ridiculously easy to use, it's also packed full of powerful features, such as create and send professional-looking invoices in less than 30 seconds, set up online payments with just a couple of clicks and get paid up to 4 days faster, see when your client has seen your invoice, and put an end to all the guessing games. FreshBooks is offering a 30-day unrestricted free trial to my listeners. To claim it, just go to freshbooks.com/Meb and enter the Meb Faber Show in the How'd You Hear About Us section. Again, that's freshbooks.com/Meb. And now back to the show.
All right, why don't we hop into some reader Q&A questions then? This actually is appropriate because you were talking on market cap. You touched on market cap a few times earlier. The question is, Meb has suggested several times that almost anything, any systematic index selection method, is better than a cap-weighted index. If so, why is so much of the index fund industry stayed with market cap weighting? What is Meb seeing that others are not? So
market cap weighting is the market. And so if you put together all the other strategies, you end up with market cap weighting. And let me restate that. Market cap weighting is not, anything other than market cap weighting is not better. There's plenty of strategies that are way worse than market cap weighting. So investing in expensive stocks is way worse than market cap weighting. Investing in, kind of a lot of the opposite factors are way worse ways to invest in market cap weighting. Market cap weighting is totally fine. It's fine.
Really?
It's like your parents, you coming home, going on a date or something, or saying your boyfriend or your friend, yeah, it's fine. So it's like, it's average, it's okay. But if you sort by almost anything else, so if you sort by value, if you sort by multi-factor, if you sort equal weight, if you just buy the top 500 stocks equal weighted instead of market cap weighted, it should be better. And the reason being, we've talked about this a lot, market cap weighting, no tether to value. So you end up with a lot of the biggest companies being more expensive just because it's price-based, it's a momentum strategy. And so it's fine, but it's not the best you could do. So I think almost any strategy that within reason that makes sense is going to be better. And we'll add, 100, 200 basis points, maybe, depending on what it is, 50 to 200 basis points, depending on what it is, and depending on how concentrated you get. The problem is a lot of these funds say they're doing something different and then are basically closet indexers. We talked about this a lot, where they basically look exactly like the S&P 500. So you got to give yourself a chance, particularly if you're going to pay more than 5 basis points for that. Because otherwise, if you're going to market cap weight, you can pay 5 basis points. And the reason you said, why do people do it? Is infinite scale. So you can manage $50 billion, no sweat, with market cap or more. But if you're going to be different, you have to be really different. And so there's a lot of tools out there that we've mentioned in past episodes on active share. Wes has probably my favorite at Alpha Architect, where you could type in a fund or a ticker and it'll show you just how concentrated and exposed to a factor it is. And there was a podcast with Bill Miller of Legg Mason and Barry Ritholtz that's really, really good podcast, where the common phrase is that passive is like a third of the industry. But Bill Miller said, look, if you include the closet indexers, it's more like 70%. So the companies, the funds, it ended up looking exactly like the S&P no matter what. So you want something really concentrated and really different if you're going to pay more than the 10 basis points these low-cost beta funds charge.
Okay. All right. So take that answer, and then let's tie in one of your tweets of the week, in which you referenced a chart showing the weight of the top 10 largest stocks in the S&P, and those weightings are currently near all-time lows compared to historical weighting averages. So does this lend itself to the idea that flaws in market cap weighting can ebb and flow in their intensity based on how much of the top stocks in an index, how much they command of that index from like a weighting perspective?
Yeah, I mean, if you look at times when market cap weighted index is particularly bubblicious, like 99, you'll times, what? That's a word, isn't it?
Love that word.
And you also got to be careful. Obviously, the U.S. is one of the biggest markets in the world, but if you look at some small countries, you'll have one stock being 1/5 or a quarter of the index, right? So it can get particularly distorted in countries and sectors where one company is like 10 or 20 or 30% of an index. But in the US, it's usually quite a bit more diversified. And you rarely see a company, it's something like the 4% rule. if you see a company pop its head above 4% in the US, it's like the Madden jinx, like where the Madden video game, if you're on the cover, it's like you're going to get hurt the next year. It's like if you're a company and you hit this 4% in the US, historically, it's like your stock is about to get taken to the woodshed.
Who was it we had on who was discussing that? And Apple had crossed the
I think it was Ramsey from Luthold.
Yeah.
I could be wrong. But, I mean, there's no reason for that to be a hard and fast rule other than just market cap in general is tough because of the creative destruction. When you're making a ton of money and you're one of the biggest companies in the US and you're successful with high profit margins, like someone else wants that too. So one of my favorite takeaways of markets in general is the super high, turnover. Like, so that if you look at the top 10 companies each decade, it's a different list almost every time. And the attrition rate of companies is so high where there's so much turnover of companies dying and failing. And it's the same way with dynastic wealth for people. So the Rothschilds of the world are probably huge outliers versus so many families, or companies that have high wealth and it goes away. I was reading a stat somewhere. I took a picture on my phone where it said something like 90% of high net worth families, it over the next generation, it ends up not sustaining. That seems high to me, but anyway. But same thing with companies, but that's a beautiful part about capitalism, and that's the way that it should be.
Well, do you think that's based upon, is that on an individual company level, and they can be fantastic or terrible all on themselves, or do you think this is based upon industries that go in and out of favor?
Well, I mean, think like classic examples, buggy whips, so it changes, and 50 years from now, we'll probably be talking about the industry of, augmented reality stocks. Well, or 2 years from now, we got marijuana index stocks.
That's kind of where I was going, was thinking about the potential exponential growth in tech that's ahead of us in the next decade, 2 decades. To what degree, when you're looking at, it's a smaller sub segment of the market, but when you're looking at like U.S. stocks, if you're not going to go straight value play, to what degree would you want to say, all right, I want to really hone in on tech, on sort of cutting edge?
I got one word for you, Jeff: plastics. So like each generation, I mean, if you think back to all the revolutionary technology and ideas, I mean, think about radio and TV and space flight and plastics and everything else. I mean, what will it be 10, 20, 30 years from now? Who knows? But thematic is tough because thematic, I mean, if you were to ask the listeners, what do you think the best performing sector of all time is? You're listening, or actually it's industry. It's not a sector. There's only about 10 sectors, but 100 and some industries. It's tobacco, right? The most boring non-tech industry of all time, but it's trounced everything else. So, from an investment standpoint, people love thematics for some reason. I mean, if you look at, a lot of these thematic ETFs like Hack or the cybersecurity that people, because it's a good story and it's something they can kind of attach to. But as we all know, there's a massive difference between a stock and or a business and sector and a stock. So, a stock, you want something that generates a ton of cash flows and is probably cheap. A company and a sector, you want something totally different, but people get attached to certain ideas and concepts over time. And again, those also wax and wane. At various periods in history, people want different things. In late 90s, it was tech, and mid 2000s, it was commodity and real estate and dividend stocks. And this cycle, it's something different, yada, yada, on and on.
Why haven't you launched a vice fund? Tobacco, alcohol.
Because in general, I don't think that thematic investments are a good idea. So
tobacco is the best performing industry of all time.
Right. In hindsight, I mean, so one is that and again, those are industries, so they're small by definition. And it's fun and it's interesting to give people that choice, but it's not the best investment approach. Right? Why would you limit yourself just to one sector or industry? But as a part of a whole portfolio, and then say, well, would you market cap weight the tobacco sector? Or would you use a multi-factor value composite? All these things. But In investing, you want as much breadth as possible. You want to be able to choose from 2, 5, 10,000 securities because it gives you a much bigger universe. But thematic, look, if you want to play around with 5% of your portfolio.
That's assuming, though, that you're taking those decisions out of your investors' hands.
By the way,
how about having sort of concentration and then let them diversify throughout their broader portfolio?
By the way, the multi-factor approach probably would have selected a lot of tobacco stocks. So by default, you end up owning a bunch. But look, if people want to play around with thematic trading, buy cryptocurrencies and do it with a small percentage of the portfolio, fine with me. Or in your case, option trade.
Love my options. By the way, I don't know if you saw it. Speaking of tobacco and alcohol, George Clooney, they sold Casamigos today for $700 million. By the way, potentially $1 billion. With
this is an article I would like to write with you. And I thought about this when I saw that. Is we talk a lot about the huge difference between building wealth, so getting rich and staying rich. Mm-hmm. And so we often say asset allocation. A lot of stuff we talk about in this podcast is in the later bucket. It is about staying rich. And building wealth and getting rich usually requires some form of concentration. So it's starting a business or having a highly concentrated investment or something like that.
Buying Bitcoin and Ethereum.
You could, theoretically, you could, live the janitor where you live a lifetime, save, and invest, and eventually you'll get wealthy. But if you're looking for, say, a kind of an exponential or more shortened time frame, how to build wealth, it's owning a company or owning the cash flows, right? Mm-hmm. Or building it, or concentration. So I think a really fun article is say, let's look at the top 20 producing celebrities or entertainers, right? And say, of their net worth, how much of it was from their art and how much of it was from the business. So, I can just name 10 offhand. So P. Diddy, Sean Combs just sold part of his clothing line for, I think, hundreds of billions. Dre made a ton of his money off not his records, but the Beats partnership. 50 Cent with vitamin water. What's his name? Paul Mitchell, the hair guy, made more money off his tequila brand.
What was his?
His was it's a really famous one. It might even be Don Julio. I can't remember. But so really famous entrepreneur and probably made good money off shampoo, but he was like, I made way more money off tequila than hair products. Mm-hmm. So many of the examples. And a classic example, of course, is athletes with endorsements. Their brand and a lot of people are learning this, their brand, they parlay into business. So they become, Kim Kardashian, sex tape, but she made probably most of her money off of her app game, does some ridiculous amount of revenue.
Staubach, real estate.
Really? Mm-hmm. For the listeners under 40, Jeff is talking about an old football player. But it's probably it would be a really fun article, and it's a really interesting takeaway, and I think it says a lot about brand, but also says a lot about business. And you really want to be owning businesses and being a part of. Dan Aykroyd, he had a pretty famous vodka.
All right, so this brings up an interesting point. Is we talk about sort of traditional asset allocation. To what extent should a younger investor be specifically designating a larger than usual percentage of their portfolio to go into private placements or something that can really significantly increase your portfolio versus just the oracles of the world?
I think you can do that, and so you're saying kind of don't limit your universe to just public companies. And so here's the challenge on a couple things. I have a number of comments. One is that think about owning Amazon, which is one of the best performing stocks, but public, and you've had multiple 50% drawdowns. We just wrote an article talking about it had a 90% drawdown in the tech bubble. So despite owning one of the best performing stocks of all time, you had to sit through 50 to 90% losses. And how many people can do that? Very little. So the benefit of private, either being involved as a founding employee or investor, is usually you're kind of locked up. So you can't trade it even if you wanted to, and it's not mark to market. So you may get an update once a year or every 3-5 years. And I think that's a really interesting area. And so going back to an area I'd actually never heard of that was really interesting to me was this concept of search funds. And so Patrick, we mentioned him again on Invest with the Best. He did a couple interviews with some Harvard professors, and there's about half dozen schools where they'll teach, even if it's undergrad or MBA, younger investors, but plenty are in their 30s and 40s now, basically how to search for a local or national business. So something like a cleaner company or a company that supplies, makes bread in Vermont that trades for 4 times earnings that you could come into and, potentially grow or modernize and make a very healthy return on investment. So there's a number of ways to do that on top of, I'm a classic example. My net worth is 90% dominated by Cambria, but it's, a company that have built concentrated wealth in the sense that it's, been doing it for a decade and everything else.
It's going to be weird when I take over your position and boot you.
And the Uber, what's that guy's name? Just got booted. They have like top 6 of the executive is unfilled at that point. I'm a Lyft shareholder, so I'm happy to hear this. This isn't to say that you can't grow wealth with a diversified portfolio, but by definition, a diversified portfolio in general is meant to keep up with inflation and grow it some. But the whole key there is super long time period. So if you're 20, you can utilize that long time period, compound at 5% real, and eventually get wealthy. Mm-hmm. But if you're looking for more kind of an outsized exponential get rich, then it's owning some sort of business. And a lot of people have done it in real estate too, but that's the same sort of concept where you're buying into apartments or buildings that then you're leasing out and renting and getting cash flows. So
to what degree do you think most investors don't fully grasp that they get in the market and they think that
I think a lot. I think a lot. And so, because you're seduced by the high return numbers. I'm going to think about in high school, just the compounding. If you just start with $100, right, by the time you're 50, you will have $10 million, type of chart. And you're like, whoa, if I just do that. And that's true. It's the numbers don't lie, but they say, all right, well, picture half of this going away 3 times. And so there was an investment book, and I'm going to blank on who the name was, where he advocated, he said, look, actually, if you're a young person, the correct investment is a 2 times leverage version of stocks. And on paper, that probably is the best investment. But you'll have to sit through potentially losing 99% of your money at some point. And most people can't, because most people can't. It's just too hard. Mm-hmm. It's not. Anyway, so, but I think we should update that. I think that'd be a fun article to write on, and a side article to write would be it'd be like how to grow money, how the best celebrities and entertainers have built wealth, and also the aside is how many have imploded it, because so many are so. There was an ESPN 30 for 30 on a laundry list of entertainers that have made tens, if not hundreds of millions of dollars and are bankrupt. Yeah. Mike Tyson, Allen Iverson, there's like a gazillion. And it's because people extrapolate, certainly how much money they have indefinitely into the future.
Yeah, there's also a lot of bad advisors who get them into things like, what was it? There's something
very predatory too.
Yeah, well, you always have your harem who's sort of surrounding you, just leeching off you until the money dries up.
But you read about so many. I was reading Tim Duncan. People always get in the press. We're like, suing their advisor for putting them into a solar panel deal in, Wyoming. And meanwhile, they got paid 5% to put you in the deal. And it's just the vast majority of, I'm surprised the NFL, all the major sports, NHL, baseball and everything, it says, you know what? And they probably have this, so I don't know. We're setting up a deferred. You're gonna have if I was a robo advisor listening to this, I would say we're gonna go pitch all these sports, leagues and say you sign up, you're gonna get an automated investing solution for 25 basis points, but you know what they need? They need the forever fund. You're gonna get locked up and you can't spend this. My favorite is was it Bobby Bonilla, who when he negotiated his contract says, no, I don't want a huge upfront payment, but you're gonna pay me $1 million for the rest of my life. So the Mets have to pay him still. It's like $1 million for forever, I think, which is a brilliant move because, anyway, we're just ranting at this point.
I do want to write the article with you about sort of entrepreneurial, start your own business type activities. I mean, I think that is the way to real wealth far faster. And I think so many investors get it wrong.
It's a lot of work too, but like you mentioned, also investing in private companies. So a classic example is arguably the best performing venture fund of all time, which was Chris Sacca's Lowercase Capital, where he was an early investor in Uber and Twitter. And it's fun to read his history because, he had times before that where essentially highly leveraged, kind of almost went broke sort of things a couple times in debt. And I feel like there's 1,000 stories where the opposite of people did try to do what Chris Sacca did and went to zero, right? Mm-hmm. Lost all their money. But highly concentrated, highly knowledgeable. And Buffett talked a lot about this. Instead of putting all your eggs in a basket, pick a couple eggs and watch that basket. Where if you can pick private companies and do an enormous amount of research and have more either information or better understanding or whatever, and concentrate in those companies, that's an awesome way to build wealth. But it's a ton of work, and it's it's hugely different outcomes. Like it's concentrated. It's tough. It's hard.
I mean, that'd be an interesting show. Is what's the appropriate due diligence required for researching private companies? How do you really know? I think that's a world a lot of people don't really know much about. No,
it's hard. Check out Patrick's episode for the search funds, and then the Harvard guys put out a book. We'll put it in the show notes on basically how to do search funds. And there's actually like a dozen funds that invest in these young entrepreneurs. So there are search funds where you could actually invest in a search fund that'll invest in a diversified group of these young guys. The problem with those, though, is they don't have any potential liquidity, really. So if you like buy a bread company in Vermont, like who are you going to sell that into in 5 years? Same sort of thing.
Well, also, if it's a fund of funds, you're not necessarily getting the concentration risk that you need.
So it's good in that way. So it's well because these are targeting. So yes and no. Anyway, let's move on.
All right, whatever. All right, next reader question. I still can't wrap my head around how to use commodities in a portfolio. The Ivy portfolio promotes putting 20% in a broad commodity index, but in the podcast, I've heard you discuss the financialization of commodities futures leading to loss of roll yield. So what's the answer here? Include commodities as an inflation hedge, but be prepared to pay the price of long-term drag, or forget about commodities and just focus on stocks, bonds, real estate.
We've long been promoted commodities. The general mood on commodities certainly gets pretty extreme at times. Mid-2000s, oil 150, every institution endowment on the planet love commodities.
Do you have any current thoughts on oil right now?
Hold on. And now, like, you see all the institutions divesting commodities. Harvard's now selling all their goats in New Zealand. It goes through same sort of thing we talked about earlier, ebbs and flows on commodities in general. I think a long only approach is fine. I think a long short or long flat approach is also fine. I think, Ray Dalio, largest hedge fund in the world, often says, we talked about in the prior episode, if you don't own gold, you understand neither history nor economics. And I think in his allocation, he proposed owning like 15% in gold or something. Anyway, so implementation is, well, there was the first generation commodity indices, which weren't necessarily optimal. So they didn't take into account roll yield and all these other things. So most commodity investments happen through futures. So listeners, you can think about you buy a commodity contract, futures contracts that say expire quarterly out into the future. And depending on demand, you could have a situation where they're either in backwardation, which is the future commodity prices are lower than the current contract, or contango, which is they're higher. And so if you buy them in certain ways, that roll yield is either positive or negative in your favor. And historically, a lot of the critics say, well, look, the roll yield historically was in your favor, but now over time it's different or it changes. And that's partially true because money has come in, but also you can devise indices that will take advantage of that instead of being just kind of dumb. So there's all these new 2.0 versions of commodity funds and indices that have better or more optimal roll strategies that I think helps. But in general, I mean, commodities is something that you really kind of need to see unexpected or just inflation in general. That's where they shine, particularly gold, either those type of environments. So I see it as a diversified part of the portfolio. How much, that's kind of up to you. Our Canadian listeners probably have a lot more. Our Aussie listeners have a lot more. but I definitely think it's a reasonable portion.
Do you do any research personally into, back to the idea of oil and it's plunging right now? Do you follow oil or gold or anything else with more specific interest?
It's often very commodity specific. So, we did, some old posts where we looked at a lot of economic factors on asset classes and, gold, for example, it's widely known that it loves negative real interest rates. That's when gold particularly does great, where inflation is higher than current interest rates. Trend following works great, of course. We showed that many times in the past on gold and other commodities, but the market for wheat is going to look totally different than the market from cotton, which looks different. There's so much, and there's also no insider trading. Remember, like commodity, if you're Cargill or you're one of these huge producers, you definitely have more information than everyone else does. And so trying to predict fundamentals base, I think would be really tough in commodities. And oil, there's a great, God, I'm going to blank on this quote. Man, it's so good too. We'll try to post it in the show notes. While you talk about the next question, I'll see if I can find it. But it's basically Exxon CEO or ex-CEO talking about oil prices and basically how it's like impossible to forecast. Oil prices, Exxon CEO. We'll see if I find anything. But it's tough. And the beauty of commodities too is you have so much of this. It's supply and it's like Econ 101. The cure for high oil prices, where all of a sudden you have these new technologies come on, and all of a sudden, people extrapolate it in the future where oil prices were going up to 1,000 and yada yada, we're running out of oil. Well, guess what? People say, "Damn, I can make a lot of money with oil at $100," and they invent fracking, and all of a sudden, nat gas gets hugely competitive, and wind and solar. So all of these things happen. Science kind of takes over, which is great, and that's the way that
free market economics.
Free market.
All right. Next question. Please explain the difference between the unadvised practice of performance chasing and the highly encouraged practice of momentum investing.
I think there's a pretty key difference, and that is performance chasing has no rules-based approach. So usually people's performance chasing, they find a hot sector, they buy it. So they have usually no buy methodology other than their neighbor or what they read in the newspaper. But more importantly, way more importantly, is they have no sell methodology. So usually they sell it when it goes down by 50% or something, right? So momentum, at least you have buy and sell rules. It doesn't mean it always works, but you have rules to take advantage of when do I get in, when do I get out? Same with trend following. Entry is one of the usually least helpful, but novice traders most interested in entry. I want to pick the top. I want to buy the bottom, but then they have no exit. They don't have a process for selling. And that's way more important. I've seen research that shows you can build profitable trading systems with random entries because you have certain sort of sell rules that are trend following or whatever they may be. So I think performance chasing is you don't have a system, but that could also be extrapolated to a lot of types of investing.
One of my biggest fears with trend momentum is
I just want you to stop there. What are your biggest fears, Jeff?
We don't have time for that on this show. Just getting whipsawed around. So I'm curious to what extent, the 10-month SMA is pretty well known, pretty well followed if you're doing trend and momentum. To what extent, though, have you or people in the business backtested tons of different time frames and decided upon the best? Why is 10 months sort of the go-to? Is there a better optimum time frame to not get whipsawed out?
There is a better optimal one, but the problem is it won't be the most optimal in the future, or unlikely to be the most optimal. So you want to try to find what you would call parameter stability. And so back in our old 06 white paper, we said 10-month moving average wasn't the best return to risk across any of the parameters, but it was in the middle. So you could certainly use 3, 4, 8, 10, 12, 14 months and probably be just as fine. 50-day, 200-day, whatever it may be, because you're still capturing the same thing. And I think it's totally reasonable to use multiple measures. So you could theoretically use, the 50-day, the 200-day, and the 300-day and scale in and out 30% each of your position, and that's gives you the blended average of all of them. So you see this a lot with CTAs, where they use maybe like a dozen trend following systems, where one may be a range breakout, one may be a trend following, one may be, so that you end up capturing the same stuff, but it's not a binary outcome. If you do a trend following with just 200-day on U.S. stocks, like we said earlier, you were either all in or all out on the 1987 crash. But maybe if you use 2, 3, 4, 5 of them, the problem for most people is it gets complex.
I was about to say, do you buy into that? Because what that makes me think of is Jason Su's article, in which he talks about the fishing lures.
Yeah, where
you have the wooden one that did just as well as all.
I think the worst thing to do would be to have one, and then when it stops working, switch to whichever one is working today. Yeah. So you run, but I think having a blended average, trading as many markets as possible, trend following is the whole point. So, we've had a lot of CTAs on the podcast in the past, and, a lot of these guys will trade 50, 100 plus markets. So that's the really key way to diversify. Is you could diversify across indicators, but you could also diversify across markets.
Okay. All right. Next question. Potentially the last one.
Hopefully, we have some lunch here. We have Goan food. Have you ever had Goan food?
Can you explain what that is?
It's Indian. It's kind of seafood centric, but seafood doesn't really travel well with delivery. So I think we got a lot more veggie and chicken.
How are you as a chef, by the way? I feel like you've cooked once or twice, and it's been pretty questionable.
I know. I cook a lot, and I like to experiment. My way of cooking is I rip out recipes or find recipes. I'll put them in a book, and we'll cook them once, and then I throw them away. And so that's my method to kind of teach myself. So it's everything from roasting, baking, sous vide, frying, grilling, you name it, right? And so there's a lot of experimentation.
All right, I'm regretting asking you this
hold
question.
on, I'm almost done. And so if I cook something that ends up with a recipe that's like all world, I'll save it. But I only have about 5 of those. And I was reviewing it the other day. One was like a bagel breakfast casserole. Ooh. Where you like chop up bagels, put it in a casserole dish. Listeners, Jeff likes anything casserole or crock pot related. So if you have a crock pot recipe, send it in. Jeff makes the same one every single week.
I've got a couple.
And then the one I just made was some sort of like roasted potato with tomatoes and feta, just like basic stuff. But, like going back to the sous vide, I have a new sous vide now, the Innova, which is great because you don't have to have your own dedicated sous vide machine. But I would say half of it comes out good. A quarter comes out amazing, and a quarter is basically like inedible. Like it's really bad.
I must have been there on
and maybe it's even more than a quarter. Like a third is just kind of like, and my problem is as a chef, I'm more like my mom, where it's like tablespoon, and I'll just grab a handful of salt. So I'm particularly bad at baking because it's a lot more exacting. And I made some biscuits the other day, which were just like they were like bricks.
All right.
But the good news is we have
rambled on long enough.
We have a dog that likes eating leftovers, so he gets a lot of snacks.
Let's tie this back to one last markets question here. All right. I want to know your thoughts on implementing lifestyle glide paths for an individual or client's portfolio. Your quant style approach looks at risk a lot different than most, but I do see value in reducing portfolio risk as you come closer to withdrawing money. The question is, which risk or which approach do you use to reduce the risk? Regarding your Trinity style approach, does that mean reducing from, say, a Trinity 5 to a Trinity 3 a couple years prior to retirement? Any thoughts?
Yeah, I mean, this is under category of not a strong opinion. I think it's fine. I think just adding more in bonds and fixed income as you get older, totally fine if you want less volatility. I mean, the big problem there is, a lot of people. You got to include the human capital, which means, so do you have any other sort of income? Do you have Social Security and pension? Because those are very bond-like investments. So theoretically, if you have pretty cushy income elsewhere, you don't want to double down on more bond-like income, probably. So there's a lot of factors, and I think this is where a number of the advisors really are helpful, and you'll see the robo platforms eventually incorporate a lot of this where, it's very situation specific. So for a lot of people, in general, I think it's fine. But for some people, I think it needs to be totally dialed in differently.
Who was it we had on who was discussing how we're going to live till 120?
Edelman.
To what extent, did that, do you buy into a lot on that? And does that change the way that you potentially see asset allocation as you're getting older? Because we're sort of operating on this false premise that we're going to be out of here at 80 to 90 when in fact our money needs to last another 2-3 decades.
I feel like my lifestyle and adventuring puts me in a much higher risk of the not living forever category. I feel like the way that I'm going to go is
based
probably
on the cooking
not,
you described. That
probably
puts you out
not.
pretty
Yeah.
early.
And meanwhile, we cooked last night and got food poisoning. So FYI, I didn't get it. I don't know. I think just the common sense is expect to live longer.
Yeah.
Whether that's 80, 100, 120, I don't know.
Well, started a business. Get back to our entrepreneur.
This podcast is falling apart. It's been too long since we've had calories. Anything else you want to call it?
Do you want to discuss Riskalyze?
Yeah. We launched, our company launched a new offering. If you've still made it at this point, I doubt there's 4 people on here. If you're an advisor and want to partner with us to do an automated investing solution, we just launched one, partner with Riskalyze. We are a founding is the wrong word. We are a initial launch partner with them where you can allocate to Cambria Trinity strategies. And for more information, just go to Riskalyze and look up their autopilot feature or email or call them or us for more info.
It works.
Cool.
Take us out.
All right. I'm going to be doing some traveling. If you find yourself in San Francisco, New York, Amsterdam, Orlando, and maybe one other, I can't remember, come say hello. Thanks for listening today. Feedback. Send Jeff questions at feedback@themebfabershow.com. You can always find the show notes and other episodes at mebfaber.com/podcast. Subscribe to the show on iTunes. If you're enjoying the podcast, leave us a review. Thanks for listening, friends, and good investing.
Today's podcast is sponsored by The Idea Farm. Do you want the same investing edge as the pros? The Idea Farm gives small investors the same market research usually reserved for only the world's largest institutions, funds, and money managers. These are reports from some of the most respected research shops in investing. Many of them cost thousands and are only available to institutions or investment professionals, but now they're yours with the Idea Farm subscription. Are you ready for an investing edge? Visit theideafarm.com to learn more.